and had a great stable day job to learn the business from. And then along the way, I kind of call it my side hustle. The downturn happened in 2008, 2009, and it felt like real estate was really cheap, because it was in hindsight, but nobody had capital, nobody had any money. So was able to cobble together a few dollars and bought my first deal from a bank, and that led to probably, honestly, 12 or 15 more deals from that same bank. That things kind of snowballed from there.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
Appreciate you joining me today. So for today's episode, what I want to do is go back and replay one of my favorite episodes. So Ryan Cahalan is the CEO of Artisan Capital, and I had him on the Brenneman Blueprint pretty early on. This would have been back in April of 2022, I think the episode came out. And we really went long form into what he's done to build his firm. And Artisan Capital has right around $1 billion of property today. And what's interesting with Ryan's, what we kind of pulled out in the episode is just really the hard work it took to get to that point where, if you were to just kind of see it now, you'd go, wow, look at this established firm and doing these big deals. But we really went into what did it take to get to where he's at today, and then and obviously what they're doing today. But what's stuck with me from this episode was a lot of the conversation about the hard work. So Ryan basically, he worked more or less 2 jobs for 20 years, where he was working a regular real estate job, he had done different things for his career, where he was working at a multifamily investment firm and then was a lender, but all the while was building up his real estate portfolio, getting investors, building the sort of seed portfolio that then jump-started Artisan. But it was really, I loved hearing about the hard work, because this is, getting Brenneman Capital going. And so far, what I've done in my career, it's really been a lot about hard work and not being afraid to take your shot. So, I'm recording this right now at 6:23 p.m. on a Friday before a holiday weekend. So, it's, this is just what it's like. And so it was great to have Ryan talk about it kind of with no filter. And something too that, the podcast has grown so much, and, so thank you all. But the podcast has really grown a ton since this episode came out. And so I wanted to make sure, if you skipped it, here it is again. Definitely worth a listen. If you're a broker, you can learn about what are these, buyers thinking these days. If you're a lender, if you want to build a real estate portfolio, you want to build a real estate company. Here's Ryan, a $1 billion portfolio. This is the guy to learn from. So I want to make sure that this episode is, given its fair due. So, and then, if if you're watching on YouTube, sorry if the color's flickering a little. We got this late Texas sun coming in through this window up top here. So that that's what you get for shooting it at 6. So, but anyways, I think that you all will find a lot of value in this, and I just appreciate everybody listening and supporting the podcast, liking the videos on YouTube and subscribing and leaving ratings and reviews. It's really it's been surprising how much this thing's grown. So, I appreciate you all listening, and then, just want to go back and pull out an episode that, we did pretty early on, that's still very applicable today, and added a lot of value for me, and I think will add a lot of value for you all as well. So we'll catch you later. Today's guest is Ryan Cahalan. Welcome.
Hey, Drew. How you doing?
Great. Yeah. So really pumped to bring Ryan on. He's the co-founder and CEO of Artisan Capital Group. Kind of joking before we got started together, not as partners, but just sort of collectively, we own over $1 billion of property, but it's 200 million me, 800 million Ryan. So I'm happy to get here and learn something today.
Well, the 800, we have a lot of good partners. So Artisan Capital Group, while we're the general partner and the sponsor, we've got some good investors that helped us get to that 800 million marks.
Yeah. So I've got, questions I want to ask Ryan, and you kind of hear, we've known each other for like 10 years. So hear more, kind of hear how it all started.
Yeah, who would have thought 10 years ago we were sitting here with, combined portfolio of $1 billion.
Yeah, no, it was surreal. I mean, maybe I was probably like 20 million maybe then. And, yeah, so no, we were a bit from that. Well, nice. Well, yeah, let's just jump into it. I mean,
Sure.
How'd you get started to start us off for a view?
That's actually a great question. How I got started in real estate. I think the first question is why did I choose real estate, or how did I get into real estate? And growing up and through high school, college, I was always pretty good with numbers. I mean, numbers came natural to me, and I liked once I got into finances courses, I enjoyed those courses and learning about that, and numbers were natural. More so than stocks and bonds with real estate, it's more of a tangible asset. I do appreciate good design, and I like nice building design and the physical facade and curb appeal of buildings. So for me to combine my skill set in math and finance with real estate as a fixed asset made a lot of logical sense to at least start down real estate as a career path. So had an uncle in the business who was a good mentor of mine that kind of taught me a thing or two. And really coming out of college, University of Northern Iowa, graduated in December of '99. I didn't really know, what I wanted to do or where, but I knew I needed to get out of the state of Iowa where I'm from. And I love Iowa, and you'll hear we've gone back to Iowa in a pretty big way. But for me to spread my wings and just kind of, I think, learn a lot about myself as well as my career path, I needed to get out. So I went to Los Angeles for a couple of years and joined HFF as an analyst, and white collar sweatshop, worked probably 100 hours a week type thing for a couple of years, but learned a bunch. Really started to put together the big picture of commercial real estate with regards to the asset types, the different food groups from office, industrial, retail, hotel, and obviously multifamily. But more than anything, just learned how deals are capitalized and structured, the types of capital from debt to equity and every nuance in between. And then took the opportunity to go back to graduate school at University of Wisconsin and got my MBA there and continued down the real estate path, but really used graduate school for more of a gut check, as a young 20-something to make sure I was going down the right path. And I wanted to use grad school as an opportunity to take some accounting courses and marketing courses, entrepreneurship courses, just to make sure that, I was on the right path. And one, it helped me kind of round out my education, some other functional areas. But two, it did reiterate the fact that I love real estate and I wanted to make it my career.
What was your undergrad degree in?
Finance and economics.
So then, at that point, did you feel like you could have used some more formal education on real estate because you've already been working in it long enough? So what was...
in hindsight, did I learn a ton in grad school that I didn't already have a good understanding for? Probably not. But, graduate school is a good way to kind of, one, meet a network of people that are still my friends and colleagues to this day. And I'm not going to lie, at 25, I wanted to go back to school and have a little bit more fun.
Yeah. So, and two, that reason I wanted to ask that is I think a lot of people who are, 24, 25, 26, I was thinking the same thing when I was 26. I had just moved to the city of Chicago and was kind of wondering what would be like the next step. And this is so like a lot of people are thinking like an MBA is needed or like the next step when they're in their mid 20s in business. So curious how that worked out for you. And
it worked out great. I mean, to me, it gave me a chance to kind of pause, step back, and make sure I was on the right path. And then when I landed in Chicago in 2003, April and May of 2003, really launched my career in earnest, and I felt like I was on the right path. And my first job then was with PPM America, originating mortgages, and one of my mentors, Julian Foster, him and I teamed up, and we originated a lot of good mortgages, again on all different asset types. But going through that process, it affirmed where I really wanted my career to go. I gravitated towards multifamily. I just liked housing as an asset class. I thought there was a lot of long-term stability in the space. But again, having that lending background with PPM was very beneficial because it taught me the nuts and bolts of how to underwrite deals and look at different pro formas and that sort of thing. And actually, an interesting thing, again, you asked how I kind of got where I'm at. Every deal, we'd look at the sponsor too. And I remember looking at balance sheets and personal net statements for a lot of the borrowers. And clearly they had a different net worth than I did.
Yeah.
But it really, what it did is it helped me visualize, instead of getting, wealthy by making a lot of current income, I saw how their net worth was generated on the equity side. I go back to an accounting class. You got short-term assets, long-term assets, liabilities, and the bottom right in my mind of this balance sheet is net worth or owner's equity. And I realized to make yourself wealthy, it's not really an income equation. It's how can you buy assets that create value over time.
Right.
And I learned that by analyzing these financial statements from a lot of sponsors, and really that gave me kind of the carrot of that's what I want to strive to do.
That's very interesting. What did anything cross your mind seeing those sponsors in terms of did they have anything special compared to you in your head, or?
And maybe not just those sponsors, but as I've met successful people over my life, a lot of times you meet successful people that are very high acuity, really smart. You have, no doubt how they got to where they're at. And I'm not going to disparage anybody, but then sometimes you meet successful people and it's kind of the opposite. You're kind of surprised that, this person, just had the balls to make things happen, and that served them well, and they succeeded. So I can't say that I can put my finger on one thing that identifies success, either from a financial statement from a smart person or somebody else, other than doing it.
Right.
You can talk about good ideas all you want, but you got to get yourself in the game.
Yeah, and that's why I asked. I've noticed the same thing where there's people you'll meet and you'll be like, wow, they're so much smarter than me. I can't, almost can't believe it. But then for every one of those, there's someone where you're like, wow, if he can do it, I definitely can.
That's exactly right.
So that's why I asked that, where I've noticed that too. And then because I've thought that myself, just doing deals on my own, where I see people that aren't really necessarily have any special skills compared to me, or or kind of thought, well, if they're doing it, why couldn't I?
That's right.
So
that's right.
It's interesting. Yeah. Because you saw that as a lender then.
Yeah, I did. I saw that as a lender, and what my mindset as a mid-20 something as a lender, if you get your principal back and a little interest, that's a successful deal.
Right.
And every deal I worked on, I wanted to be on the other side of the table, the person borrowing the capital to take on risk, execute a business plan, and then they can be rewarded handsomely.
Right.
So I like that idea of capturing upside, and really got to the point where I also understood that I was more of a risk taker and entrepreneur than a lot of other people. And, in general, that served me well in life. Now, you've got to always understand the risk you're taking. I think people that are blind to risk, that's when you get yourself into trouble, and maybe we'll talk about this a little bit later. The first couple of deals I did, I went in, especially in the downturn in Chicago in 2009, 2010, when I didn't have a lot of money. I was pretty leveraged buying assets, but I felt like I was going in with my eyes wide open. And it was definitely a risky proposition that not everybody would have been able to do. But fast forward a few years, values went up, everything paid off. And that's really what got me going in my career.
Yeah.
My ownership career.
Yeah. And so you want to pick it up there or talk more?
Actually, let's go back, because I think, how I got started then in real estate. While I was in Chicago, that the first investment property I ever bought was in Cedar Falls, Iowa, the college home, or the college town that I went to school in at Northern Iowa. And I had a very good friend who now works with me and runs asset management, Marcus Chelson, lived in Cedar Falls and was working in the service industry. And he had local knowledge and, the ability to lend sweat equity to a project. I had some capital, and together we were able to buy some properties. I would front the equity. He would oversee, and we would split the profits.
Nice.
So, we did one, and then we did second, and I think we got up to 7 or 8. And frankly, I don't think I even stepped foot in half these properties.
Yeah,
but I had good eyes and ears on the ground, and that's when you go back to my visual of owner's equity. That's how we started, creating equity. Both Marcus and myself. I mean, he was doing it from a sweat equity standpoint and putting in the hours, and I was kind of running the numbers and could satisfy the lender requirements and that sort of thing. But that's really how things got started. And then fast forward a few years, and you see you've created some equity value there. And here in Chicago, I then went from PPM and joined Walton Street Capital, was building a multifamily operating company with David Levin called Levin Realty Advisors. So I went to work for David, and really over the next 8 years, I was on a plane underwriting markets, underwriting deals, and looking at assets, and had a great stable day job to learn the business from. And then along the way, I kind of call it my side hustle. The downturn happened in 2008, 2009, and it felt like real estate was really cheap, because it was in hindsight, but nobody had capital, nobody had any money. So was able to cobble together a few dollars and bought my first deal from a bank, and that led to probably, honestly, 12 or 15 more deals from that same bank. That things kind of snowballed from there.
Nice.
So
Yeah. So then HFF in LA, got your MBA.
that's right.
Then
PPM.
PPM as a lender.
Yep.
And then you moved on the principal side.
Principal side, yep.
With
And
the
that,
bank.
yeah, that really kind of got me where I wanted to be, recognizing, again, through my few years of experience, that I wanted to be on the principal side. Had great exposure to the Wall Street Capital guys, really smart, taught me a ton, really have a lot of respect for them. Again, I was kind of David Levin's right-hand man as we, built a portfolio, but also built a company, which,
Right.
Some of what I learned with that experience as kind of the second in command has served me well as I built my own company.
Right. I was thinking that as you're saying it, where you wanted to be a principal, then you started doing that on your own, let's say nights and weekends. And then you eventually able to switch your full-time day job to that as well.
Yep.
And then, really learn a ton that way.
Yeah, no, that's right. I mean, it was a great 8 years. And again, the last 4 or 5 years of that, I was kind of working 2 jobs. But, it served me well. And that when young people ask me for advice, I mean, that's often the first thing I say is, don't quit your day job. Like, your day job will allow you to take some risks and just work twice as hard, and nobody said you need to work 40 hours a week. In fact, if there's one thing I can identify about successful people, they work hard and, 80, 90 hours a week. And I'm not saying you shouldn't find balance in your life, because you certainly should, but I've yet to find a recipe for success other than just outwork the next person.
And yeah, and I think it's interesting what you're saying, because I've said the same thing so many times, where when I went out on my own, I already had 5 properties that I owned with a partner, large ones, and then 2 on my own. And, so then I already had 7 deals paying me.
Yeah.
And then I went out.
Yeah.
Where it would have been, to your point, I kept my J job.
Yep.
And I was buying deals on my own for years. And then eventually it got to the point where just buying stuff in the evenings,
Yep.
weekends is turned into a full-time thing now.
Yep.
And then that's when I did it. But exactly. And so what's interesting to think, like, during all that time, I basically stopped watching movies and sports nearly. And,
Yep.
and it's not much has changed. Now I'm older, so my free time pivoted to like my kid basically, but
sure.
I never even went back to doing that stuff now. Instead of watching like college football,
You got to prioritize your time. And I think and I've been guilty of this, a lot of successful people, their first priority, it probably is their job or their business. And I don't know that should be number one. Obviously your family, your friends, your loved ones should fall ahead of your profession. And I've probably had to resort my priorities over the years, which I'm working on. But again, when I'm in my mid 20s and early 30s, late 20s, early 30s, it probably helped me avoid some bad habits as well. Staying out too late at night and that sort of thing. So
yeah,
you just gotta lean in and work hard and make things happen. And actually might be a good dovetail. After 8 years with Walton Street, when I did make that jump out on my own, I felt like I was at a crossroads in my career of either needing to double down, recommit to working kind of the private equity institutional model, and work my way up the ladder at a private equity firm, and I'd say fight, but kind of earn more equity in deals and that sort of thing.
What age and what year is this?
I was so this was 2012, so I was 35. It was about 10 years ago. Right now is when we had closed a big deal in Nashville, kind of coming out of the downturn. Very good buy. And, as an acquisition guy, I had a little piece of the deal and a little piece of the back end. But I wanted to get that deal closed. And I knew I wanted to go into 2013 with kind of my own plans and my own ideas. And really doing the small deals along the way, because I did start, raising some friends and family capital. It gave me confidence to see an idea or have an idea, see an opportunity and execute.
Right.
And then, slowly start doing that on larger scale. And, I could have stayed with, the institutional route and worked my way up. But, I recognized a little bit there's the tendency for groupthink, 20 smart people sitting around a conference room where everybody thinks they might be a little smarter than the next guy. And you just kind of talk and nothing really happens. And at the end of the day, usually right decisions are made that way. But I think I was a little bit more impatient, and I just wanted to rock and roll. And a lot of my instincts were for scrappier small deals that I could cobble together. You need to move quick. And at the end of the day, I just felt that the time was right for me to make a move, go out on my own, and scratch that entrepreneurial itch. And whether this is the right mindset or not, I always kind of felt if I failed, if I worked hard for a couple of years and I failed, well, I could always go back and work my way back in the rotation.
I always say that. I always say that. Where you could have just gone back to Levin or another similar place with all your experience.
Yeah, I think I was employable.
No, for sure. Where I always say that, where like the worst case isn't you're gonna be, like homeless or something. Like you have the degrees and the experience. You just could go get another job.
Sure, that's exactly right. And I tell you what, October 1st of 2012, that first Monday after I left, I've never been more motivated than that day I woke up and I didn't go to my job, and it's all on you. So it's like, talk about working hard. That's when I almost like tripled down to make sure that I wasn't, going to be a failure.
Makes a lot of sense.
Fear can be, and it was scary, but I also say this, fear can be a huge motivator if you let it, and for me, that little element of fear when you knew you didn't have a paycheck coming in every 2 weeks really helped accelerate my drive and my motivation and my work ethic.
Yeah. And a lot of these things you're saying are the same things I've mentioned with getting something going. Like first, you don't need to, your day job really does help a lot with experience and paying the bills.
Sure.
Because even these deals, you could do well on a deal, but then if you have to use all that money to, just pay your own bills, you're not really compounding anything yet.
That's right.
You're spending it where, if you can stay in your job longer, that's great. And then same thing on just going back to your job. I always say that.
Yeah.
And that's like a big takeaway to me. So it's interesting that you've saying a lot of the same stuff I have.
That's right.
What do you, when you went out on your own and you said October 1st, 2012?
It was end of September, thereabouts.
Okay.
Yeah.
This is interesting to remember the exact date.
Well, you remember pivotal moments in your life, right?
Yeah. Because I can remember roughly when I had to quit too, or it was in like July 2011, where it's like a memorable time. What did you have at that point going, where you had some deals in Iowa, some in Chicago?
We hadn't really done the Iowa thing yet. We bought some of the college houses that we still had, but I really look at 2010, 11, 12 is when I, went long, and the cycle was such that in 2008, the value drop in 8 and 9 was substantial. And I just focused in my backyard. I always felt like I knew what a 2-bedroom, walk up would rent for in Lincoln Park or Wrigleyville or Bucktown or Wicker Park. So I just focused on my backyard. And it was one of those environments that, doesn't come around often in your career, that there was real blood in the water. And if you showed up, and a lot of times I didn't have the money necessarily for down payments or even to show proof of funds, but you just kind of figure out creative ways to make that work. I just focused in my backyard. And then in hindsight, the opportunities didn't really dry up, but I felt like by 13, 14, the buying opportunities, the real distress opportunities had dried up. And I just say, but cap rates were, you used to be able to buy like, 9, 10 caps, right? And then they were like 6 or 7. I'm like, oh, that feels pretty pricey. So that's when I took a step back and really analyzed a couple different things. I analyzed capital flows nationally for multifamily. And by then, Nashville and Austin were popping. East Coast, the coasts were very, very strong, but in the Sun Belt as well. But, the big hole that I know well, the upper Midwest, I just felt like was being overlooked by not only institutional investors, but private investors and whatnot. So I'm completely biased here because I'm from a small town in Iowa and I love being from Iowa. And I always felt that Des Moines was a little hidden gem of a market that nobody was paying attention to. So in 2013, 2014, I really started studying Iowa as a case study of a market below 1 million people that had a very diversified local economy, that had population growth, educated workforce, quality of life, a cool factor.
Right.
And I always said if it was more than 1 million people, the institutions would be keen to that market, but they weren't. So I just felt, I used the Moneyball strategy. I felt like Des Moines, Iowa was that, that athlete that was maybe short and tubby, but could always hit and get on base. Like it was just being overlooked by the other guys. They were looking at the wrong things when evaluating markets. So if you're truly looking as an investor, I think the term risk-adjusted return is way overused and misused in a lot of cases. But my view at that time was there's markets like Des Moines that are not evaluated properly, and that they're they're trading at a premium really to what market value or a discount to what market value truly should be if you're analyzing the true risk of that deal. And smaller markets, the argument is, 5, 7, 10 years, who are you going to sell to? And I always hedge that response with, well, if we have a longer term hold, I don't care if I'm locking into a great yield. If we as an investment partnership have a longer term horizon and I'm distributing a cash yield that's much higher than you can get anywhere else, and we feel that the stability of the income and your NOI is better than other places, to me, that's where you should park some dough.
Right.
So that was kind of the origin of the strategy, which then became Artisan Capital Group. But I do need to mention, after I went out on my own, I put all my net worth on the table, raised some outside capital and put together a nice portfolio. But I felt like I was in a defensive situation just from a income standpoint. If something happened, if a property needed a large capital infusion, literally, I think I emptied my bank accounts and bought these assets. So I was approached by a group, and I did go back into the kind of the working world for a bit in 13 and 14, 15. A mortgage originator out of Minneapolis, Oak Grove Capital, kind of reached out and allowed me to join them in a couple manners. I helped the principals analyze investment strategies on their own account, but also originated some mortgages for Fannie Mae and Freddie Mac. So I kind of went back into that defensive mode of having a little bit of a paycheck while I was still able to go out and execute my own business.
Yeah, interesting. Makes sense where you had all your money, invested, and then.
Well, I just felt like I was certainly exposed, and I was covering all my bills and everything was fine, but I didn't have a whole lot socked away. Let's put it that way.
Right, or if you find another deal, it's starting to maybe you felt like, well, my investment base is getting like a little. It's sort of like fully invested. What's my next move?
Right.
It's interesting,
and I've heard I've heard several smart people say, you make a lot of money when you have access to capital in a down market, right? And even though things were improving, if things had another downturn or whatever, I didn't have any capital to take advantage of, the next downturn.
Right, and even by like 2015, it felt like the prices were high. That's what's
in hindsight,
wild.
Sure, but things have run another 7 years since then, right?
Right, but isn't it supposed to be like a 7-year economic or real estate cycle? So,
all I know is real estate's cyclical. I'm not going to call the next cycle, but it feels like things are fully priced right now.
Right, or even in 2015, I was thinking that where I was buying deals and then.
Well, that's when I pivoted and pivoted away from Chicago and went into this whole new strategy or thesis of secondary, tertiary markets. Because if you looked at multifamily cap rates between primary, secondary, and tertiary, not only the difference between the Sun Belt and the Midwest, which was a huge delta in cap rate, but then Chicago to Minneapolis, Minneapolis, Kansas City to Des Moines, there's probably a 50 basis point premium cap rate every step down you went. And my view is, in Des Moines, if you could buy at a 7 cap and that asset's trading for 5 in Chicago, that was a good relative trade to start buying Des Moines. So that was the pivot I made in 15. When it felt expensive here, that's when we started really buying the assets that were rolled in to start Artisan Capital Group.
And that thesis always made a lot of sense to me when I first heard about it, or even a lot of the fundamentals in like Des Moines, it's better than Chicago, yet it's trading at a discount relative to the income.
It was, and now, things changed, right? Last deal we bid on and chased really hard in suburban Des Moines, there was 35 offers, most from California and New York. So that tells me that I'm not saying I was smart or lucky, but we were right on the thesis 7 years ago. And now what's the next one? So as an investment company, that's what we always try to do, is find the edge or a little bit of a strategy that maybe the bulk of people are missing. Real estate, I hate to say it, it's a herd mentality. And we try to look the other way. If everybody's going one direction, okay, let's look the other direction. And what are people missing? And maybe they're not missing anything, or maybe they're running from something for a reason, but maybe there's opportunity in the other direction.
Right. And what's interesting too, if you have that business plan, it's different too. To me, it seems like it's easier to raise money. I know it at first, if you're the first whatever deal in Iowa for that group, I'm sure it wasn't easy, but
no, it wasn't. Yeah.
What's interesting is once you have that sort of really going though, I feel like now, hey, you have a unique idea that's working and you're coming to them where that, the best example I have of that, obviously Harrison Street here, where they, right after the recession roll out with we're going to focus on these recession resistant asset classes. Mm-hmm. You pitch all these institutional investors that are in the normal food groups, office, industrial, multifamily, et cetera. This is like something new.
Yeah.
And it's it's a great offering in terms of, in a way, I mean, it's more than this, but putting your money in something else and sounding smart, and so that really resonated, and they've killed it.
Yeah.
Doing that, obviously. One thing I was gonna almost joke about. It's interesting because I talked to, let's say, people that are newer in the business.
Yeah.
They've never seen like where the cap rates were different. Like, so I joke, like when I started, you'd go on a webinar with, let's say, Marcus and Millichap or CBRE, and they would have a matrix of the cap rates doing what you're talking about. Chicago downtown is a 6 cap, but the third ring out suburb, Aurora, it's an 8 cap.
Yeah.
And then you go to Iowa, same thing, and it starts at an 8 and then goes up. And then they're just used to like, oh no, aren't they? Like, they should all basically be the same, right? And it's
different risk thresholds, different. Yeah.
But it's interesting now to see, because then, I mean, you guys were definitely got in front of what turned out to be a big trend with people moving into tertiary markets.
Yeah, and I mean, some of that was maybe propelled by the pandemic, but I also think the thought process was right. And if we went in and made the trade, so to speak, we wanted to, establish scale, and we were able to do that from 2000, really 15, 16 to 19 into the pandemic year of 2020, and had a good critical mass. And we started the company, I rolled in 1,000 units that I bought as a GP, and Artisan Capital Group started the end of 2017. We then bought basically 1,000 units a year for a couple of years, and had critical mass. And we did that for a couple of reasons. One, because we wanted to drive operational efficiencies for our strategy, and really be known as, if not the best, one of the best owner operators in the upper Midwest, and a company with strong kind of institutional backgrounds and experience that are applied to a very specific strategy in a newer market. So it was fairly well thought out in that way.
One thing to jump in on, so then you roll in 1,000 units, those were acquired while you were working at Oak Grove, right?
Yeah, Oak Grove sold to JLL, and that's another, I guess, kind of anecdote that I joke about, but I'd made the decision I wanted to be more entrepreneur in my career, and Oak Grove was entrepreneurial, but then they sold to JLL, which is a great company. We work with JLL every day, but JLL is one of the biggest real estate companies in the world, and that's not the direction I wanted my career to go. I wanted to go more entrepreneurial.
But also, I just wanted to highlight the working hard element, because now you had said you were maybe around 35 when you started buying again in Chicago, and this is now almost 4 years later. So you're almost 40, and you're more or less still working 2 jobs. That's what I wanted to point out. Where you on the side bought 1,000 units. I've never.
Yeah, I don't know if I'd advise that.
Yeah,
I was fully transparent with JLL, and in fact, they were very supportive to my future plans, and I think it was a good win-win, because I certainly helped the JLL team as they were expanding their multifamily practice and outreach. But I didn't see another way to do it.
Right. It's if you start at zero, then all this time where you're buying the first ones, that's just money coming out of your pocket on your own money, your own living costs, and running the company if you have any employees or overhead.
Yep.
But I just want to point that out, because if you would just sort of casually look and go, oh wow, 800 million of property must be nice, but it's like,
the first 80 million was already bought when we started the company.
But more of the point is, there was 20 years where you basically worked 2 jobs.
I guess I've never thought of it that way.
Age 20 to 40, pretty much.
Yeah, I guess I've never thought of it that way. But
then one time you went out, and then you got all your money invested, and then you went back to they'll just call it a job, even though it's lending. It's more of a eat what you kill type deal. But where you make another pivot, where you got to have had to make a lot of pivots and work really hard to get even Artisan started, is my point. Absolutely.
I mean, my career is not a straight. I don't think anybody's career is really a straight line. Maybe some people's are, but mine was not a straight line. It was once I kind of had some experience underneath me and realized that housing was where I wanted to spend my career. I kind of had a vague vision of what we could do. And when I say we, because I knew whatever I'm envisioning was going to take, a team, a village to get it done. But I knew what we could probably accomplish. But sometimes you got to take a step sideways. Sometimes you even have to take a step back, but you still need to know where you're going, and you got to pivot. And whether it was going back to work with Oak Grove and JLL or whatnot, I knew what my end game. I knew what I wanted my end game to be. You just had to work to get there.
Right.
So,
but just to highlight that, because then even now, when you said we rolled in 1,000 units, I was like, wait, that's all still done while you're doing something else.
Yeah. No,
that's other units were in Chicago. So that's
a great point.
Yeah, that's
a great point.
And
I want to say too, those assets I was able to buy really in 2016 to roll into Artisan, that came from a capital relationship that when I was still buying the small deals, doing friends and family, and I wasn't very good necessarily at putting myself out there. While I had conviction in the assets we were buying, the plans, I'd never really had to raise outside capital before. And, a little luck, but also a lot of hard work and networking, met an individual and really an equity source that had some capacity behind them, that one believed in a guy without a business plan or without a business card or a company to buy these assets. And I really give them a lot of credit. And whether, again, probably a little luck to find that capital relationship that allowed me to get those seed assets.
And that was an individual? That was the trigger.
Was an individual behind a large company and became more than just the individual. But there was a nice equity source that helped get me started.
Yeah, because then that eventually grew, though, where he knew other people. Then,
that's right.
Yeah, they came in the deal with him.
That's right.
Introduced.
And there's still a great relationship. They help us with some co-investment opportunities from time to time, and want to do a lot more with them. But I will say I want to give that them credit because it really helped me get started.
Yeah, and it's interesting how things like that snowball, where you have them come in on one deal and you're not sure what's going to be the next thing, and then you find another deal, and then he pulls into whatever coworkers or his neighbor.
Yeah,
and then all of a sudden it's interesting how that actually plays out. So
it's funny how things can spiral like that.
Yeah. So then I think it'd be real interesting to hear about Artisan today.
Sure.
So then what? So we have the strategy laid out, where it's Class B multifamily in Iowa initially.
That was initially, yeah.
Why don't you run me through what you guys are doing today?
Yeah, absolutely. Well, one, we're up to 12 people. I mean, the biggest thing I take the most pride in is the team we've been able to put together. When it was time to start a company, I didn't want to do it by myself. I lobbied a gentleman I used to work with, Mike Perry, to help me as my co-founder. And Mike's good at a lot of things that I'm not good at. I think I'm good at, capitalizing a deal and finding investment opportunities and networking with investors and the kind of the front end to get a deal closed. Operations, investor relations, asset management, project oversight. That's where success is had. And Mike was he was my asset manager when I was at the Walton Levin entity, and I always said, I need somebody like Mike Perry. I need somebody like Mike Perry. And finally, I just, begged Mike Perry to join me. And after the fourth time, he finally said yes. And we were off to the races. So it was the two of us working in a co-working space in the Loop. My goal at the time was thinking, okay, 5 years forward, which would be basically this year or next year, I hoped that we'd get to 3,000 or 4,000 units and have like a half a dozen employees. Well, things started snowballing. We're now at 12 people and just shy of 6,000 units. But I think we can scale with the team we have. But beyond Mike, first couple acquisition guys that joined me, Whit and Eberly and Greg Marks. Whit focuses on market rate. Greg is student housing, but really smart guys that were able to come in, kind of see the vision of what Artisan could be and allow them to be entrepreneurial in how they work and operate and go find good deals. Sean Fogarty, a good friend and colleague, joined as a partner in 2019. Brought on in-house counsel somewhat recently, Tiffany Harper from formerly with Magellan Development. Marcus Chelson, who I mentioned earlier, who is my lifelong friend and original business partner back in Cedar Falls. Wanted a career change, so to speak, and joined as boots on the ground in Iowa, overseeing asset management, and he's elevated to run all of our asset management at this point. So, who I met, we got a couple of young guys, Dan and Ian, who help grind numbers and help on asset management, which has been fantastic. Allie Zerbel oversees all of our projects, whether it's big or small. She's our utility knife, so to speak. Who am I missing? Jake Gantz just joined us as an asset manager as well, and I think that gets us to 12. Yeah, just really proud of the team that we've put together here, and
yeah, I'm sure it's interesting. You're spending all your time now really building the platform and running the thing. And I'm experiencing a similar thing. I don't have 12 people, but 4 that work for me and full time that work on the deal doing. And it's interesting where it's been a while since I underwrote my own deal.
That's one thing, people always ask me what like the biggest challenge of growing a company is. And, you don't really think of it when you start the company, but you got to get the right people in their places. And there's just so much to do on a daily basis. So we've got good people that are kind of executing and whatnot. I try to be somewhat cognizant of tuning into how people, are motivated, and try to, periodically touch base with everybody just to make sure that we're on the right track and that they're, getting what they want out of the job, and that it's, fulfilling for them. Not something I thought about in October of 2017 when we started the company, but a critical piece of the component. So that doesn't necessarily come natural to me, but I recognize that I want to create a good environment for people to work and to have, a lot of satisfaction in their job. And not easy to do when you're growing so fast and you've got a lot of people working very hard. But it's something I'm focused on and trying to make sure people are in the right spot, so to speak.
Yeah.
The other thing is what our strategy is. I mean, I just mentioned, the original strategy was going to Iowa, and I feel like that's kind of played out for now. So it's what's next. And we took a step back, certainly in COVID, and analyzed a few different things. We think suburban Chicago is a great place to buy right now. Not a lot of people are looking in Chicago. And it's the third largest city in the United States. And while we've got fiscal headwinds and real estate tax challenges on how you underwrite those and whatnot, certainly some headline risk. But we think Chicago's a pretty good contrarian play right now, and it's in our backyard. So we like that. And then student housing, we feel like is trading a little wonky right now from a national standpoint. Pre-pandemic, there were student housing assets that were trading basically in par on a cap rate basis with apartments. And we don't think that should be the case. There should be a little, premium there, 25, 50 basis points. But in a lot of cases, we're seeing 100 basis point spread between student and apartments. And we just think that's a little bit of the edge that we were talking about earlier,
Right.
that we're trying to capitalize on right now. So,
Yeah, it makes a lot of sense. Had a rough year with the COVID and people trying to break leases, so then that disrupts the whole
that's
market.
scary. That veers on that makes things uncertain. And whenever there's uncertainty,
Opportunity.
there can be opportunity. Right.
Yeah.
So that's what we try to exploit and focus on.
Yeah, because the other day someone was asking me, why does someone even want to invest in student housing? Just because obviously there's just more management headaches and we'll just say repairs needed.
Which is why there should be that spread, right? I mean, it's not an apartment deal. It's a different asset type. It's a different, capital, intensive asset.
But actually, on the flip side, I would say there might not even need to be a spread, depending where I could make the case there shouldn't be. It's just different where the rents, you have more headaches, but that's in repairs, but that's already factored in.
It should be in your underwriting.
Expenses. So
Right.
we're just putting a cap rate on the NOI now, which already has that baked in. And you could say the rents are high for what it is, but that's already still factored in the price. But the real the thing that's great with student housing, and I had 4 student housing assets and owned 2 or 3 of them still during the 2008-9 downturn. My rents never dropped. Every year they went up, even 2008, 9, 10. There's no recession. These are at UW-Madison. And UW-Madison, let's say class B minus, like student rentals, which is what I had.
Sure.
So then to me, that's what I told them, where I was like, the reason people go in that is it's just not correlated with the economy necessarily. It's correlated with how the school's doing, almost how colleges are going to do.
Well, and the interesting thing about students, sometimes when the economy is bad, universities do better because more people are going back to school.
Right.
So
I feel like the risk almost in student housing is more making sure you're going to be at a college that's still growing and not, because I will say with student housing, like some of these colleges where they're at risk for going under if it's like a bottom rung school. And this is getting so expensive to go to college now where people are going to realize.
A couple things there. We absolutely focus on enrollment trends, right? I mean, you look at freshman enrollment, hoping that's painting a good picture that freshman enrollment's up, that they're going to be there for 3 years and a nice trend from there. I hate to say it, but, we agree some of the directional schools, and I went to Northern Iowa, are probably going to be in trouble. I think some states need to figure out how to keep those schools, how to market those schools better, or create some sort of competitive advantage for those schools. Probably, cheaper tuition.
Was that private or public?
Northern Iowa?
Yeah.
It was public. Yeah, it was the 3rd public school in Iowa.
Yeah, but even for that, at least cost-wise, it still makes sense. The ones where I'm sure there was something comparable.
Sure.
Where, and I know the ones in like the Milwaukee area, because that's where I'm from, where it's 40, 50 grand a year to go to now. And it's, I don't know, the 15th best college in the state, where it's like, at what point is it not worth spending 200 grand a year?
Right. And those are, and again, maybe, there's some opportunity there if you're willing to take a risk, but we're not going to make that bet. Pre-pandemic, we had a different strategy. We were looking at kind of secondary universities. Now we feel, we want to look at the Power 5 conferences, top tier universities, focused on schools with good enrollment trends. But student housing supply can change in the market pretty quickly, and we see some markets that the supply pipeline has just crushed the market because the demand is somewhat fixed, if you will, and it can only absorb so much supply. But you analyze all those things, which is why on the students front we have more of a national approach because there's just not as many markets that we're going to try to enter. But it's been a good market for us, or a good strategy for us, and we're pretty optimistic about our prospects there.
How are you sourcing deals today?
That's a great question. Maybe I'll start with how we historically have sourced deals. And when we got started, really in 15 and 16, specifically in Iowa, I saw inefficiencies in how assets were sold in the state of Iowa that I wanted to exploit, right? A lot of mom and pop ownerships, a lot of off-market transactions, a lot of street brokers or kind of the bird dog brokers would bring me deals direct, and I love that inefficiency, right? I think the goal is you buy inefficient, and then when we're ready to sell, you hire the best broker for the job, and you make sure 100 people see it, and you really market the heck out of your sale. But I like the inefficiency of buying deals. So, and I went down the list of our REO, our real estate owned. I bet you we bought half off market or quasi half market, and it's getting harder and harder to do. One, to find those opportunities, and especially in a hot market right now, everybody knows that you put it out there, there's going to be probably a bidding war. So historically, it's been more inefficient ways of sourcing assets.
One question to jump in and we've done something similar. When we redid our website, I counted up how many deals were like a repeat broker, fully off market, or repeat seller. So I don't have the breakout of just full off market, but it was 80% of the properties I bought were one or all of those three things. But most of them really were through a broker still. It wasn't, I've only bought a couple properties where it was like one of them I literally called the neighbor property, and he sold to me eventually. But even on that, he eventually hired a broker actually. Because he didn't know what it was worth, and then they were going to put it up for sale, and then that broker contacted us. Sure. But anyways, what have you done where, and this is something where I have, let's say if I bought 40 properties, I've sold less than 10 of them. So normally I'm selling with the broker I bought with. Yep. But in these, let's say I'm in the same boat as you, some of these situations where it's like the person is not in their wheelhouse really. Yeah. But they did bring us the deal. Yeah. And usually you want to list with who brought you the deal. Yeah. How do you manage that? What do you?
We're selling our first round of assets right now. And in some cases we've chosen brokers that didn't necessarily bring us the deal. We view it as we're in this for the long haul, and brokers that bring us deals, we execute, we buy, and that's a successful transaction for them. And there's really no guarantee about the sale. We're going to evaluate the sale process based on what's best for our investors and the asset, and ultimately, us as sponsors. And if it happens to be the same broker, great. But if it doesn't, we feel there's a better broker to market and sell the deal, we're going to hire the best athlete for the job. Right. We're all, big boys in this game, big boys and big girls. You've got to bring your A game every day. And if you're not the right one to sell a deal, we're going to hire somebody else. But I also think that shouldn't prevent people from, continuing to show us opportunities, because we're very fair on the buy side too. And we do our best. We pride ourselves on trying to execute and doing what we say we're going to do.
Right. And that's something where I think on all the ones where I've sold, it's been with a broker where it made sense to go with, that also sold it to us, I think, but a couple of them we didn't. We used somebody else we thought was better. But it's a tough conversation with the broker that, brought you the deal, because a lot of them are working under the assumption, like, if I brought you the deal, I should list it, not based on necessarily what their abilities are at that point. Just sort of, that's like a courtesy.
I get it. And we would certainly give that broker the opportunity to, evaluate the deal, give us their marketing proposal, their value, and, who and they think they're going to sell it to, their potential investor list. And, I also think it's a little bit of an old school mentality that, just because you brought it, you're going to sell it. I think you got to bring your best every day. And if you're not it's a tough conversation, but don't be afraid of having a tough conversation. If you really think that there's a better broker, here's why, and, have that conversation.
Right. Because that's something that I've ran into, but I know a lot of other people are thinking about, because I sold 3 deals last year, and on 2 of them we used a new broker.
We're very cognizant too of, look, we've got a lot of really good relationships on the broker side, and at some point you got to spread it around a little bit. Make sure that everybody gets a deal, that at least groups that you think you're going to transact with. This is a 4.5-year-old company. We're going to be in business for a long time, so we want to make sure that we have multiple good relationships on that front.
Right. Are you guys managing your own properties, or what?
Great question. So when we started the company, that was one thing I always got asked. I mean, if we are fully vertically integrated and have our own management company, and I'm in a co-working space with 2 or 3 other people, I'm like, that's the extent of our company. Like, this is all I can think about right now, let alone hiring a maintenance guy on a 400-unit property in Iowa. So we evolved over time, and frankly, we probably made the move to create our management company sooner than I ever would have expected. But in 2019, we tried some third-party managers that just weren't managing the way we would manage. And with our institutional backgrounds, we're very hands-on asset managers. And it was pointed out to me once that the way we asset manage, we were already doing half the management.
Yeah.
So that was kind of like a light bulb situation for me. I was like, okay, that's a really good point.
I've realized that in some of our deals too, where I feel like, except for the hiring, we're basically doing this too. We're setting the rents. We're reminding you this thing's not on the. You said it's on the market. It's actually not when you go on the internet. So you need to step it up. Where pretty soon it would have been the same amount of time to just say that to the person sitting across from you, like, hey, your listing's not showing up.
So for me, I think it was kind of a mental barrier of like maybe being intimidated by the concept of having a management company and employing. I mean, if you own a 400-unit property, that's probably 8 employees right there. Which to me, seemed like not thankless because you want good people at your property, but I never really wanted to be in the HR business, right? That's not my cup of tea. But what we did is we partnered with Tina Smothers, a great gal in the state of Iowa who has really strong, deep experience in property management and had started her own management company. And we were able to bring our scale of a portfolio to Tina and let her run the management company. We're partners in the management company, have a lot of input. But she's been able to scale a great company. We probably self-manage. I should know the exact number, but 3,500 to 4,000 units within our portfolio. We self-manage, and we'll probably grow. I mean, originally started with the state of Iowa. Now we're taking over management of our 800 units in Kansas City and Lawrence, and we'll see from there. But I still think using third-party management in markets like Chicago makes a ton of sense. You got to be good at what you're good at and recognize what you're not good at. And, we're good and well known in the state of Iowa. I think we can attract good talent and, have the right people at our properties. But Chicago's a different game, and student housing is a different game. We just bought a deal in Reno, Nevada. For us to self-manage in Reno, Nevada and track the right property manager and maintenance supervisor, that's a taller task from 2,000 miles away.
Right. Or learning the other thing too, people don't think about, and it's obvious once you get in a few markets, you also got to learn all the laws in that market.
Sure.
Which you figured out in Iowa over time, and Chicago, I'm sure. But then you buy your first deal in Reno. What's the lease supposed to look like there?
Right. And you have the right licenses in place.
Right.
And all those things. So
you brought that in house, but it was also not only once you have the scale units, the right unit count, let's say, but the right sort of other people at, let's say, the corporate level who could do that.
Right. And Tina brought on Josh and Kelsey and Devin. We've got a really good team of, really senior leadership within the company to help, provide the support to the properties that we really need. And that doesn't happen overnight. And, frankly, 3 years ago, I thought that was going to be very difficult to attain. And another thing I take a lot of pride of that we're able to attract really good people to join the company. So, but the other thing that led to us bringing management in-house in hindsight is, you can put your pro forma together and you have good basis for your assumptions and your OpEx and certain things. And, if you hire a third-party manager and they're not thinking of your budget the way an owner does, they're thinking of it, a lot of times what's the path of least resistance, replace versus repair on some items and that sort of thing. And we realize we can only pass the buck so long to our investors, right? By saying, the manager missed it, property management missed it here, they're running heavy. And at some point you got to grab the wheel and control your own destiny. And that's ultimately what we ended up doing. We made a management change that didn't pan out, brought in more of a national into Iowa, and weren't able to get them to see operations the way a true local owner operator would and should. So we made the decision to take over, and it's been a lot of work, but it was the right move.
And then your your partner's name is Sean, and what's the other? Mike?
Sean Fogarty, Mike Perry are my two partners in Artisan Capital Group.
But then Mike, so he initially he sort of ran point on even bringing in Tina and all that, or
Yeah, well,
someone
Tina was a
else?
relationship that I'd had for a long time. I bought a 14-unit deal in Tina, and she was the property manager on that. But Mike is kind of the glue. I mean, everything operations, Mike has his fingerprint on, to the point where we recognized we needed to elevate, not only because he deserved it, but it was the right move for Marcus to oversee asset management of the assets themselves. I mean, we have a 12-person company and $800 million of capitalization. Mike has a lot on his plate, from just company operations, from tax returns and investor relations and all that. So it was just kind of a matter of, okay, as you scale a company, you realize the roles that need to be filled and try to get people in the right place. So, and Mike's, the way his mind works, he's very ops oriented and very detailed. So he's the perfect guy to run that. Sean, who joined from HFF, I mean, Sean ran investment sales for HFF alongside Marty O'Connell and Matt Lawton for like 15 years, right? So he's sold billions of dollars of deals in Chicago. Great person to join, because I think he wanted to get on the principal side of the business for his last phase of his career. He's from Iowa originally. He opened up our Des Moines office, so he was a perfect addition. And Sean and I overlap in a lot of ways. We both have good kind of capital relationships and underwriting and investment skill set. But we've got a lot of units, a lot of deals we're underwriting. So it's good to have him help steer the ship as well.
Right. And then once Sean joined, then you could move more to, like, let's say, like CEO type stuff. Now, not so much maybe.
Yeah, we don't really use C titles. I mean,
Right.
we're the three partners, and there's a lot of responsibilities, and we kind of each take our responsibility. But I do think that I probably think strategy a little bit more than the others, because again, I want to make sure we're always kind of on the front edge of the curve on an investment trend, and not thinking reactively.
Yeah. Makes a lot of sense.
And I'm able to kind of go up to 30 or 40,000 feet and think about that, because we have such a good team put together to execute the business.
Exactly, where you have someone who's able to do the operations, and then you brought on, if you're a broker, I mean, I'm just assuming your bread and butter is the deals. And then, so now you got someone who's an actual owner.
That's right.
And, and so very seasoned. So
that's right. Yeah.
Now you're freed up to, think about something at 30,000 feet instead of the closing next week.
Well, and, you've got to get in front of existing capital partners. You got to get in front of new capital partners. I mean, that involves travel, that involves a lot of conversations and really talking ideas and investment philosophies and that sort of thing. And, that's the other thing we haven't really touched on yet, but, to capitalize $800 million of real estate, and we've raised $200 million of equity. And, that's been a tall task. I mean, people ask me how I've done it, and I always say the hard way, because it hasn't been easy, but it's been, we've got good partners that have come into each deal. And we made the decision when we started the company that our value add was to go find a good deal and have the courage to put that deal under control, which means you're signing a contract, you're posting earnest money, you're spending real dollars, but that if it was truly a good deal, we'll find the right capital partner for that. And that's the direction we had to go, because you can have all the good conversations with investors in the world, and they might like, hey, Drew, I love you. But until there's a deal to focus on and talk about, there's really nothing to talk about. So,
and today also, everyone's so busy that even if you have a deal that you could get under contract, these LPs, they're so busy that you got to have it under contract, really, to have to
get their attention,
real conversation.
Right,
they could give a quick look for 10 minutes. Hey, if you get under contract, this looks like something we do, but we're not really looking too hard. This is a thing you might be one of 20 people off.
In my LP audience for a $5 million deal, which we're not doing small deals anymore, is completely different than a $50 million deal, right? So I needed to know what capital investment I was solving for. And, the deal dictates that. Where's the deal located? What's the equity check size? So, we'd go find good deals, and then we would have sleepless nights until we found the right partner. But again, we've found really good partners and really happy with the groups that have invested alongside us. We hope that they're happy, with us as well. And looking forward to, keeping the ship going.
So then let's say, take me through raising the money on, let's say, your first larger deal, where it went from, let's call it like a friends and family raise, or just even from individuals, to now you're dealing with a one check LP or however that looked, a family.
Yeah, maybe I'll tell two examples because one, the first deal that really kind of got us started, again, I was a one-man band and found a $28 million deal that made a lot of sense. One of the individuals that invested in my small deals had expressed interest in kind of my new strategy or whatever. So I went down and met with him and kind of laid everything out. And I think it was a $6.5 million equity check that I needed. And I was feeling him out for like 10% of that. I thought, if you give me a 10% commitment, I think I can go raise the rest. And after, a half-hour meeting turned into a 2-hour meeting, he said, okay, call me tomorrow, but I think I'm just going to do it. And I sat there for a second. I said, awesome. And then I didn't realize what he was going to do. I said, are you going to do the 10% or are you going to do the whole thing? He's like, I think I can do the whole thing.
Oh.
So I had to contain my excitement until I, got into the elevator bank and started high-fiving random strangers on the street, because that was what I needed to do to get the deal done. I knew once I had the equity, the debt was solved for, and we could take this thing down. So that, that was kind of the first deal of size. And again, effective networking and I think presenting ideas and that deal performed well. I wish it would have performed better. We learned a lot on that first deal, but really got us going. And then
was that his first deal with you? It wasn't. That was...
we did some small deals here in Chicago, but this
Right.
was the first deal that would have rolled into what became Artisan.
But then how, for him, normally he was putting in like a couple 100,000 or what? It was, 'cause this was a surprise, obviously.
Yeah,
So.
Originally that was the case on the small deals we were buying here in Chicago.
Right, because he's coming in kind of like a syndication. There's other people, there's slots, so to speak.
Yeah.
So you'd say, I'm good for
Yeah.
100 or 2 or 300, and then you meet with him on this, and he likes the strategy and this. Yeah, so that's.
And then they did then he expanded the relationship to some of his partners, and we ended up doing another 600 or 700 units, and that's when we started Artisan Capital Group, and really we're off the races.
Wow.
Since then, maybe another typical deal. Well, there is no typical deal really. I mean, every deal is unique, right, in its own way. But I think more recently we're looking at 40 to 50, $60 million total capitalizations. So my equity checks are 10 to 15, maybe $20 million. And we've been at this now for a while. We've got some good relationships. So you kind of start with your list of existing partners or groups that you've come really close with, and you present the information. You kind of say, here, we just went out on a deal today with kind of a new investment. Here's the deal. Here's the snapshot. Here's why we think it's a good deal. Here's the risks. Here's our underwriting. Here's the capital need. Here's the returns. And we've got a couple partners that we'd like to do more business with. I think they'd like to do more business with us. It just becomes a matter of do they have capacity at the time. But we're also always trying to talk to new partners. I feel like we've gotten over the hump as a company. We're no longer a pure startup. We're in our sophomore or junior year, so to speak. We've got a good team on we got business cards, we got office space.
There you go.
And again, as investment trends have changed, I think we're maybe viewed as a company that saw a strategy early on and went in and exploited it and executed. And that gets the attention of a lot of larger capital check writers,
Right.
And we'd like to tap into some of that.
But then the first deal with a, let's say, so that's an individual. Then what was the first? Because once you're jumping into these like a $28 million deal, where the earnest money come from on that one?
Well,
Let's back up.
That one, the seller was somewhat unsophisticated, so I was able to control a $28 million deal with only $100,000 of earnest money, and that's not typical. And frankly, I probably had to sell some stock, and like $100,000 was all I was able to put together.
But it was your money.
It was my money. But I knew once I controlled the deal, that gave me leverage, and I was confident enough that I could spend $40,000 on due diligence. And, if I had to walk at the end of DD and eat the $40,000, I would have done that. But I felt confident that I could raise the capital, and we did.
Yeah.
So,
And because then obviously the earnest money at that point, that's refundable.
Refundable through 30 days, but I knew that even after 30 days, there was going to be a lot of moving pieces, and I still could stub my toe. So no, you write that check, hoping it comes back or hoping it gets, contributed to the deal. But, that's a risk as an entrepreneur that you've got to, you got to ante up, you got to get in the batter's box. And, it's been, I think maybe your next question is, as we've grown, how do you continue to, capitalize earnest money? And not just earnest money. I mean, it's pursuit costs, because we've had to walk from a couple deals for findings in due diligence that we could not we have a fiduciary responsibility to our capital partners to put them in good deals. And if you find something in due diligence, whether it's an environmental issue or God forbid COVID creeps in and, you've got a deal that you're working on, student housing deal that you don't want, it doesn't make sense to buy in the light of COVID. You got to be prepared to walk. And that stings whenever you do that. We've only had to do that a couple times, but you can't be afraid to walk away from a little money, because if you don't, the alternative is a bigger mistake.
Yeah, and you're working yourself for free. You put people in a bad deal. It hurts your track record.
But on the earnest money front, able to cobble together enough, to personally fund some earnest money while we were growing. The partners of Artisan would contribute. If it was a big deal, we would go to our LP in some cases and kind of explain the situation. And, oftentimes, not often, but in a handful of times, they helped fund some larger earnest money checks. And then, what's kind of a trend right now, or has been for a while, is, we're the sponsor, we're good at hunting the deal, but there's a lot of good co-GP funds out there and investors that like to work with groups like us that understand that there's a capital need beyond what a typical operator might have for earnest money or that sort of thing. And we've worked with some co-GPs that have funded earnest money to get us there as well. What's interesting, you don't really think about, is a lot of times, acquisitions are chunky, right? You might go through a few months where you don't buy anything, then all of a sudden you're awarded 3 deals.
Right.
So it's not just $500,000 or $600,000 for one deal. That could be 2 or 3 deals in a row, or stacked on top of each other. So all of a sudden you need to have $1.5 million. You tack on some lender deposits and that sort of thing. I mean, it can be you need a lot of liquidity for that.
Yeah, I mean, even last month in total, we had about $2 million of deposits out. 2 of those deals closed. So
good for you. You got that money back.
Almost, yeah. And then we still have $1.2 million out in one.
Yeah.
So that.
And the other thing we should talk too, I'm curious if you've got a line of credit. We were able to work with a local bank in Iowa that we've done a lot with, and they understand our business model, and we can now draw on a line of credit for some of that.
What's the collateral on that?
My name.
Okay.
And my partner's names.
No, I have not been able to do that. One thing that's very interesting with how a real estate business is set up, for a second, if it was all just in one, let's say, corporation or LLC, it would be much easier to make a loan like that. But what maybe people don't realize, every deal is in a separate LLC. Yeah. So it kind of stands on its own as a business. And then those all have, loans on the property that are on that. And then you're not allowed to just put an additional loan or sign, the equity shares on a different loan as collateral. Yeah. It's not allowed on your senior loan on the loan on the property. So it's a hard business to get a line of credit like that, where if it was a different kind of business, you would go, okay, we have all this income in one company and this would be the collateral. And every year it's been like this. This is really more just a collection of fees and promotes and different things, or things you just own directly coming in. And so that I'd be curious. I mean, that's interesting. And that's a bank where that wasn't your first loan with them.
No, but we've done a lot with them, and they have the majority of our deposits. They've really become a pretty good resource for us. But to your point, you're absolutely right. I mean, every asset is a single purpose, single asset LLC, or every property is owned by an SPE. And, that's done for a lot of different reasons, from your capital side, your investor side, but also from the loan side. The agencies, Freddie, Fannie, or any lender really wants to just lend to a single entity.
And liability too.
Yeah, right. So the value of your enterprise, I mean, Artisan Capital Group, you could argue doesn't have a ton of value, but as we've grown, and we have income, fees from our asset management fees, our distributions from the property management company. So there's some fees or some income to model to say, okay, there is a hypothetical value to Artisan Capital Group, which I firmly believe is just because of the platform we've created and the strategy that we've been able to execute and perform. So there's a value to our company, but at the end of the day, I mean, we're still signing personally on these things. So if we lose $100,000 of earnest money for whatever reason, we're not going to let the bank write that off, and we're going to have to make it right.
Right, but at least it's a funding source where
it is. Access to capital like that is huge. I mean, it's not a matter of whether you have net worth there. It's liquidity. Do you have the liquidity at the time?
Right. Because even if you have on the deals where maybe you've been able to split earnest money with an LP, or they contributed it, if that got lost, who's that on in terms of the repayment?
It's a discussion up front, right? And we've been able to do it. Sometimes we'll say, look, we understand our investment deal isn't baked. So even though we're only going to be 10% of the, the capital going in, maybe the liability is 50-50. I don't know how other operators have done. I'd actually be curious what other guys say, but other times we've been able to do it at our investment ratio of 90-10. If our deal's baked with that JV partner and we need $100,000, the liability is 10 to us, 90 to them, because they understand the situation. Right. But, I don't know I think that's the exception and not the rule. I think a lot of times is, hey guys, we need this money. It's protected. We're not going to let it go hard until everybody's on
aware
board and the deal's fully baked. We just, we can contribute half. Can you guys contribute half? And that's kind of been the way it's gone.
Yeah. And on stuff that I've saw other operators doing or things we've worked on, it really depends on how much information everybody has, where to your point, if they're fully in the loop, yeah, they're probably fine splitting 50-50 or 90-10. But if they were just a truly passive person who's this out of the mix.
Yeah. You can't put their money at risk without them being fully up to speed as to what's going on.
Yeah. So then that's why there's not really like a set way. That's why if you're right, whatever you've done or I've done, it's just been deal by deal. If that LP is as in the loop as we are, right, maybe going 90-10 on it makes sense. But if they're just kind of totally out of it, like I'll put in this money if you need it early, but then if it's lost, we need to pay it all back. Yeah. And we've done it kind of every which way too. So that's
we'll say for the majority of 2018, 19, and 20, I think whatever I would have had in a IRA account or a brokerage account or investment account was sitting in a escrow account in earnest money. I mean, I just knew that to get the company going, I had to sacrifice, and it was protected in most cases, but I just had to have that money be prepared to sit in earnest money accounts as opposed to my
or working capital for the platform. Because what people don't realize too, you see they'd ask, what's your co-investment in this deal? And you're also investing some money. But what's interesting is, well, I have $200,000 of earnest money out, and then we had to make a $75,000 loan deposit, and we've racked up $40,000 of other bills.
Yep.
All those last two, even if we cancel, then I just lose $115,000 or whatever that added up to it, and I'm out. And then also you have a platform, and if there's 12 people working there, I mean that's over I can just do the math in my head, $100,000 plus a month of just money being spent on something, and then that sounds great when there's fees rolling in and deals are selling, but it's not a guarantee that there's a deal tomorrow. And then also what's tough for our business is you've got to be making the right decisions for the investors. So if there's a thing like COVID hits, the best thing you can do is be canceling deals, but you're still paying for everybody, and now you're losing all this pursuit money.
Yeah, I mean that's the cost of doing business, right? I mean that's if you have bad luck like that and a string of those, you might not be in business. But you just got to underwrite a deal or two a year for whatever reason. You're going to have some pursuit cost, and hope you win more than you lose.
Right, but I think people don't really grasp that until you're like in the seat. Because I'm in that too, and it's where you could go, almost, why couldn't you throw more money in the deal? And it's like, well, we have millions of dollars of earnest money out, and we're paying for all these people, and it's like it's not as simple as like, you just have this bucket of money with no expenses coming up or needs. Because the worst thing you do is be like, cool, I'll put in whatever, all my money in this one deal, then another deal rolls around, and now we can't pay for the employees or
we talk
money.
As we were growing, and we're still growing, but we talk a lot with our investors about that is, we want to create, it takes a lot of overhead to get the right people on the team and, have them show up and be motivated every day. And we'd love to put more money into deals, and we're at a point where we are putting larger checks into deals, but we're putting every deal we invest in, and it's meaningful for us, right? It's not a token amount, it's a meaningful check. But sometimes, I mean, especially as we've done larger deals, as a percentage of the overall equity, it might not look like a lot. And the part of the reason is, to your point, is we've got a lot of overhead to cover as a company. And maybe that equation is different 5 years from now. We can put, more percentage into the deals. But, we got a lot of mouths to feed, and want to make sure that we're doing that because it is in the best service of the investment at the end of the day to have our team put together.
Right. Yeah, that's not going to help any if we're running out of money on the operating company.
That's right.
What were you doing then for loan guarantees? Because just to kind of set the stage though, where I want to set it up though, where if you haven't done one of these deals before, typically, and it's not always the case, but as like a general rule of thumb, most lenders want a collective net worth on whoever's signing on the guarantee, either whether it's recourse or you're signing non-recourse carve-outs, to be equal to the loan amount. And then liquidity, you would know better as a lender,
10%,
but 10% of the loan amount. And that's after the down payments contributed, that's remaining. But, so then, okay, some of these, I mean, your biggest deal probably could be what, a $50 million plus loan. Like how's,
a couple things. One, those aren't hard and fast rules from the agencies. One of the lenders, can't remember, Fannie or Freddie, is more fixated on the net worth requirement, and then the other is more fixated on the liquidity requirement. So oftentimes you're solving for different things. So, we have bought a $50 million asset, and we were able to demonstrate net worth less than 50 and still kind of check that box. It just kind of depends.
Most of the loans, though, they were agency, Fannie and Freddie? Or
we've done, I think, 2/3 of our borrowing from Fannie or Freddie or HUD. We've got a fair amount of bank loans, and we've done a couple debt fund deals.
To go just kind of one at a time, then on the agencies, then do you feel like there was a number once you could clear this collectively?
Yeah, a lot of it's collective, right? So I've got my partners, anybody who's going to sign the non-recourse carve-out guarantees, they look at them, collectively, which helps kind of us achieve, those thresholds. We have been, again, a couple of years ago, we were light. We would rely on a co-GP, whether we were going to bring in a co-GP to help facilitate our funding requirement or not. Sometimes you have to bring it in because you don't have the balance sheet to satisfy the requirement.
So then on those deals, the co-GP was also signing the non-recourse carve-outs.
Yeah. And I don't think we've ever done it where an individual signs. There's usually an entity that the co-GP has to invest out of, and their entity will sign. So it's not another warm body, but it's another entity that has some net worth and liquidity that's willing to sign those carve-outs.
Right. Yeah, we've had to do that in a couple of deals where we have an investor who has a holding company he's bought these things through, and is like his holding company like blows all of our net worths out of the water.
Yeah.
So then we add that, but he's not on it personally. But it's it's kind of humbling in a way where this little thing he set up is blowing everybody away collectively. But it's the same thing with those companies. But then, do you have a number then where once, let's say, like on an agency loan, you get above like 20 million or something, then it's sort of just, it's okay. And that would be good up to like
I think the agencies, and I don't know what the numbers are, and we've done some fairly large agency loans, but after a certain number, they're not going to hold you to the specifically the net worth requirement. I think they were going to give you a little bit on the liquidity requirement. Again, I used to be in that game, and it's been a while, but I think there's some flexibility there, right? They understand the sponsor, the capabilities of the sponsor, their track record. Clearly, you need the financial, requirements to be generally in line, but you don't get to 6,000 or almost 6,000 units and not know what you're doing. I think that's one of the boxes they look at as well.
Right. Yeah, and at this point too, where there's waivers and where they can get flexible. Yeah. But what about then on? So then kind of same answer across all different lenders?
Banks are a little different because you're signing personally, right? I mean, I'm not saying banks don't care, but if you're kissing the paper and you're signing personal recourse, they want to make sure that you're well collateralized. But at the end of the day, it's not just the asset that they're underwriting. They're underwriting, all your personal assets as well. So I don't think banks have the same, threshold that they look for. And the recent debt fund we did as well, they had a lower net worth requirement, but still had to show the liquidity. So I think it's a little bit, it kind of depends on your lender.
Yep. And where I haven't, one thing that's different with the debt funds is they have, compared to the banks or agency loans I've done, they have a set amount of liquidity and net worth you need to maintain. Yeah. I haven't seen that in any, let's wait for this siren to go by.
No problem.
I haven't seen that in any of my agency loans or bank loans where we need to maintain. Have you seen that in any of yours?
I think there's one agency loan. I can't remember what triggered it, but there is a covenant. It's an annual reporting type thing.
Oh, okay. Yeah, I don't have a HUD loan, so maybe it's that one then. But I've not.
I can't. I'd have to go back and
I guess not here nor there. But that was we're doing our first debt fund loan right now, and there's a liquidity and net worth covenant we need to stay above, which is new, where everything else has been just you get approved at a point in time, and you don't need to maintain a certain liquidity, which now is a whole nother thing to think about, where now not only do you need to front all the deposits and everything and pay all these pursuit costs and run the company, but you also need to have a certain amount of liquid. So now it's just there's a lot more going on than people realize when they're like, well, you can't put in the full 10% yourself.
That's right.
It's like, well, right,
that's right.
Yeah.
A lot of variables there.
Yeah, so it's not as simple, and it's interesting where too, where right. And so when you said you've done this the hard way, what you meant is it's been deal by deal.
Yeah.
And
Yeah. I mean, I don't have the, I don't come from a very wealthy family and have like, money accessible to, a lot of cash. You gotta go find it. And like I said, every deal, the profile of the deal, location, the risk, threshold, the asset quality kind of takes you to different investor types. So our whole thesis is to go find a good deal and then, use our relationships and our network to go find the right partner.
yeah, and it's interesting.
But it does create some sleepless nights. And that's also why I say I did the hard way is you type a deal and, until you have a partner, you're kind of sweating bullets every day.
Are the deals you're bidding on today? I'm sure it wasn't like this at the start. Are you guys having to go non-refundable with your earnest money day
We've
one?
done that. It's a good question. We did that end of last year on a deal. We bid on a deal recently that we offered it. We bid on another deal recently that we did not offer it just because that was a tighter deal and more moving pieces. In my 20-year career, there's been a lot of talk about it. There was a lot of talk about it in 2006, 7, and early 8 before the market changed. And now, last 18 months has been another environment where you've kind of had to offer it up to compete, which is, again, scary times.
Right. Yep. And this deals I'm looking at, that's required essentially.
Yeah.
So then what are you guys doing if you have to do that, or anything that comes to mind where you're trying to reduce the risk on that?
Have a lot of lender conversations up front to really feel like where your debt's gonna be at the end of the day, which is tricky in a market like we're in today in March of 2022, where treasuries have blown out 40 basis points in 30 days, and the corporate bond market is wonky. So life company spreads are out. So you just got to feel good about the capital markets, and we were in a pretty good run there for 2 years with the treasury at historic lows that, you were going to get 10-year money for 3%. It's not there right now. So you've got to, you got to feel good if you're putting non-refundable money out there that the loan that you think you're going to get is there. So I'd say that's the big one. The other is you got to feel really good about the physical condition of the asset, right? You usually get environmental and, title survey carve-outs to those non-refundable deposits. But, you've got to know what you're walking into on the physical side. Make sure that your budget and your underwriting contemplates some capital for surprises. And then the other component is you got to make sure you've got your equity and can fund that part too. So there's a lot to be nervous about. But the same token, there's 2 deals last year that I wish we would have bought and we didn't get them because we didn't put some non-refundable out there. And hindsight is what it is. I wish we would have put a token amount out there and won those deals, but you live and you learn.
Right. And something not everyone might realize, you don't need to have the whole amount go non-refundable.
No.
Depending on the market. I mean, in these deals in Phoenix, we did. It was the whole thing.
Competitive, yeah.
Yeah, non-refundable day one. And then on one of the deals, there's no carve-outs for anything. Not even title survey, environmental, nothing. So on that, what we've done, all the same stuff you're talking about, equity lined up ahead of time, debt figured out.
Yeah.
And then also we would only do that if, I guess I'll back up, if we have received a clean title report of whenever they bought it.
Sure.
Their survey, which would also have no problems. And then hopefully their phase 1. And we're running our own environmental records search. Whatever
the desktop review, or
there's whatever website like Chase Bank and these Freddie inspections, they just run this environmental record search. I forgot the website, but we made an account and then it's like $500 and you get the whole record search. If all that stuff looks fine, then we'll do that.
Yeah.
And then we try to then do the physical inspection while we're doing the purchase and sale contract.
Yeah.
Obviously. So then at that point, you've kind of done everything that would be a huge item. And then again, these deals they're all value add.
Yeah.
So in prior deals, it really mattered what are the in-place rents, doing your lease audit.
Yeah.
Today, if you're buying a deal and the rents are 25% below market and you're going to renovate it, like it's not your lease audit, actually what we audited was that the unit mix was right.
Okay.
I personally
sure.
went door to door counting,
make sure
how many units there were on this
right.
one we're buying. It's 96. I went to each one and counted. It was, and then I was like, where in this, because we didn't have like a map where each unit type is, and I was like, where are the 1-beds? And because then I want to count those up now, and then the rest, and so we confirmed the unit mix completely.
Sure.
Or actually, I did.
Yeah.
during the physical.
No,
'cause
that's
all the
smart.
units were open.
Yeah, make sure you know what you're buying.
Because the in-place rents, it doesn't really matter on this deal. But if we thought
Yeah.
it was 82 bedrooms and it was actually 60 somehow, that would matter.
That's a problem.
So
Yeah.
it's interesting what you're spending time on now. It's different.
It's a different market, right?
Yeah. Interesting. Yeah. That definitely took a lot away from this in terms of useful tips, even for me. So I'm sure people are gonna find a lot of value in this.
Well, I hope so. I mean, it's been a good run. I feel you learn every day, right? I mean, if you're not learning, then there's something wrong. But a lot of hard work, and I feel like we're just getting started, though.
Yeah. So great. Well, yeah, let's leave it there, Ryan. So yeah, thanks for being on.
Thanks, man. Appreciate it. It's good to see you.
So how can, let's say there's, like a broker's got a hot deal or LP wants to get some money in a deal with you. How do they get in touch with you?
Look us up on our website. Actually, we're just revamping our website right now. So artisancapitalgroup.com. And we'd love to chat, whether it's about maybe doing a deal together or if someone has something to sell. The way we raise money is kind of changing. Obviously, we're always looking for good investment partners. So just reach out to us through the website. My email's on there, and would love to chat.
Great. Well, yeah, thanks again for being on, Ryan.
Thanks, pal. Appreciate it.
Great. Well, thanks for joining us, and we'll see you on the next episode.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.